Good morning, everyone, and welcome to Saxo's market update call scheduled for every Monday morning. I'm just going to kick off now with the big picture. So, over the last few weeks, we've seen some recovery in the broader sentiment. The market is in balance. On the positive side, we have thoughts like peak inflation, peak interest rates, and demand destruction. While on the negative side is the argument that inflation will likely linger higher for longer. So we remain on the camp that inflation threat is structural and will continue to prompt central bank action for months to come, which does mean that the Fed and the ECB may have to reassess their inflation targets later this year. And we also think that the recovery that we've seen in the equity markets over the last few weeks is still a dead cat bounce, and we remain in a long-term bearish trend. We've been getting warnings on the economy too, both from a poor showing in the surveys from the Fed. Several surveys have been out quite weak, and also from the leading public figures such as JP Morgan CEO Jamie Dimon last week warned about a hurricane, and then we had Elon Musk on Friday saying that he has a super bad feeling about the economy. Fed's commentary last week, however, has kind of restored a hawkish bias after we did see some expectations of a September pause starting to build in earlier. But just a quick macro recap from last week. I think the highlight, of course, was the NFP data on Friday, which has kind of strengthened the case for Fed tightening to continue. We have seen that play out in the equity markets as well later on Friday when the markets kind of plunged after a solid start. So the NFP headline printed 390K, which was above the expected 325, and it fell from the prior month's 436K, and the unemployment rate was unchanged at 3.6%. So it's not a surprise really that the US job market is tightening. Most companies are guiding for pressure on margins, and a further slowdown still, I think, is in the cards. Also, it's worth noting that 21.2 million of the 22 million jobs that were lost in the pandemic, the March and April 2020, have been restored. So, of course, we're going to slow down from here. Meanwhile, we did also have a softer wage number, which kind of reduces the concerns around a wage price spiral and still supports a more prolonged rate hike cycle case. So the job market is actually constrained by supply of quality labor rather than the job openings as such, which does mean that there will be further pressure on inflation, and of course the Fed will continue to tighten. We have the FOMC meeting in 2 weeks from now. It's 15th of June. So the Fed has entered a quiet period, so we won't be hearing a lot, but I guess the expectations for further tightening will continue to build. Also, we have the ECB meeting this week on Thursday. While June liftoff is obviously not in the cards, we are expecting a liftoff in July, as will be mostly on the bank's inflation forecast and any hints of an earlier than expected 50 basis points rate hike moves, especially after the record CPI prints in May. And the key to watch this week will be US May CPI. Consensus expects a slight slowdown to 8.2% YOY from April's 8.3%, but I mean, we don't give it a lot of weight. The headline is expected to slow down anyway into the months going forward because of the base effects, but we still think, because of the food and energy prices still going higher and the structural trends of deglobalization, of green transformation, it means that the underlying inflation will stay higher for longer, as I mentioned before. In the FX space, we had the 10-year Treasury yield carving out a marginal new peak for the week, just below 3%. The USD was broadly supported, and the yen was the biggest loser. We had the USD yen touching 131 levels on Friday following the NFP report. Gainers were mostly the Canadian dollar and the Australian dollar. The Canadian dollar obviously supported by higher oil prices and BOC's hawkish tilt last week. The Aussie USD could not really sustain a bounce above 72.50 with the RB on horizon this week. And Euro is also critical this week after being unable to really find a direction last week. And with the ECB meeting, I think it'll be interesting to watch how it goes. And just a quick summary on the commodities. Big gains returned to energy last week, even as OPEC ensured production increases, which we don't think it can meet, not enough to meet Russia's shortfall. And this morning we had news about Saudi Arabia raising prices for Asia. So further upside pressures on the oil are probable. We also saw big gains in copper, which reached a 6-week high amid hopes of China reopening. The agricultural commodities have been under some pressure, but we do see that the food crisis is far from over, even if Russia starts to send out grains. So again, probability of upward swings is still there. The gold is trading neutral for now, and a breakout from 1875 or 1825 is needed for a clear direction. That's it from me.
Hi, morning everyone. Definitely last week we have the reopening of Shanghai there, and also this morning we have further relaxation of Beijing transportation and people's mobility. Those are certainly very positive news. And last week Hang Seng up 4.8%, and CSI 300 up more than 2%, and MCI China up more than 3%. And northbound flow, I think, there's about 4.4 billion US dollar equivalent inflow into China, into Asia. And that actually was the largest weekly inflow this year to date. Last week, we have IT, technology and growth outperform energy and value stock. So that is probably, the market become a little bit more positive and in growth. Having said that, the price action is still rather lukewarm, and I think we could have expected the market have done a little even better. And I think probably the investors are still not entirely convinced about the sustainability of the reopening, and because the zero COVID policy can mean anytime there's any outbreak again and rise in cases, and then some cities will be locked down again. And also, I think the investor also need to be worried and not sure about whether the magnitude, the incremental nature of the policy so far, whether the magnitude and the efficacy of the policy easing are sufficient, given the backdrop that of those kind of lockdown, and also external environment is the global economic environment is not so favorable. And another concern, I think we raised it here before, is the local government budget, and it's a concern because it's the loss of land sales revenue has been hitting local government budgets, and that actually constrains local government's ability to roll out infrastructure and other spending projects. And now China is moving from more like try to reduce the probability of a lockdown, and then we will move on to more kind of widespread PCR test requirement, and residents are not allowed to move around or enter public places unless they have to show evidence that of a negative PCR test within 48 or 72 hours in many cities. And actually, some of the smaller cities already say they don't have the money to do it because the government, the state council told them, and that actually the cost cannot be borne by the national healthcare medical fund, and but actually have to the bill actually have to be taken up by the local government, and that is actually quite expensive, and some economists expecting that will cost about 1% to 2% of GDP if China consistently to do this kind of 48 hours PCR test for every single one of those large cities. And so that's another concern. And China has a very busy economic calendar this week, and the focus definitely will be Caixin services PMI that will be coming out in about 30-40 minutes time. And last month, print of 36.2 actually caused a lot of concern and pessimism in the market. And now Bloomberg consensus is calling for 46 for May, and still a contractionary, but somewhat recovery from April. And another focus will be on aggregate financing data that include aggregate financing, and loan and money supply and so on. And now I think it's markets is expecting it will be the new aggregate financing will rebound to 2 trillion yuan, and from last month 910 billion yuan. And mainly because of increase in the government bond issuance and some rebound in the new loan from 545 billion to 1.2 trillion this month. But because of the base effect and also this moderate increase, and for the total outstanding aggregate financing, the growth rate will still be around 10.2% year on year. That is considered still a subdued level, same as last month. So So that, but anyway, that would be a key thing to watch. And the exact date of which to be announced is not yet fixed, and it's between the 9th of June and the 15th of June. So it can come as soon as this on the 9th. And then under trade data, of course, will be focusing on whether export will pick up, and market expecting to pick up 8%, to rise 8% year on year, and as some of the based on container throughput data in the first 20 days of May. And we have seen some recovery in trade growth from previous month, and because of there's less disruption to logistics and production. So market is expecting 8% year-on-year increase, and then import is expecting 2.5% year-on-year increase. Import is still subdued because of the weak household demand. And then the inflation is actually the CPI and PPI on Friday. It will be less a focus because this CPI inflation is not a concern for the policymaker for the time being in China. And this month CPI might pick up a little bit from 2.1 to 2.2% mainly because of China, the government has purchased pork and to add to the national reserve for pork, and so pork price have pop up because of the price. The government stabilized the price, and pork actually is important. Is China CPI it carry 4.8% weight in the CPI data, and PPI probably will come down to 6.5% year on year. An increase of 6.5% year on year. That's a decline from last month, 8% year on year increase, mainly because of energy price and raw material price has spread too, and also the base effect. So inflation is not a concern for the policymaker, but PPI, but the still high input price still will be giving pressure on Chinese business and on their margin, still pressure on their margin. On the earning calendar, the major one, and I'm running out of time, and the major one will be Silo Biopharm, and also tomorrow, and then I think at first day will be Bilibili and Leo. And the last thing, and I think since I think we still are here, we still positive on infrastructure related stock, and especially after the State Council has asked the two policy bank last week to increase lending quota for about 800 billion RMB. So that's it from me.
Good morning. Thank you both. So I'm just going to cover the equities. So firstly, what's happening that you need to be aware of? So we know the NASDAQ and the S&P 500 did close lower last week and on Friday. And that's because, as Charu mentioned, we received better than expected US hiring data, and that paves the way for more aggressive Fed rate rises. So the market, where are we? We're still holding on to the prior week's gains. So remember, the week before, the NASDAQ rose 7% and the S&P 500 rose 6.5%. So we're still trading higher than the May low, but unfortunately the RSI and the MACD, which are two technical looking indicators, are showing signs that they're now the market is tipped to slow down. So the market is in overbought territory, and we know earnings growth for Q2, which is set to come out next month, is tipped to be slower. On top of that, as we've mentioned previously and in our notes, the Federal Reserve starts reducing their balance sheet next week on the 15th of June. So although we could have more up days from time to time, the technical indicators are in line now with the fundamentals, suggesting that we're likely to see a larger pullback as conditions weaken. However, getting to the detail at the S&P 500 sector level, there's really a lot to be said about looking at where the money is going and where money is coming out of. So the best performers so far this year are in oil and gas. So the oil and gas sector is up 65%, with stocks like Occidental Petroleum continuing to gain momentum, and they're up 143%. One of the other best performing sectors that we like and that is doing really well this year are fertilizers. So they're up 30%, followed by agricultural products up 30% as well. So this really supports why we're being overweight, or why we think clients will be best served in commodities, because they're the sectors that are tipped to see the largest growth in earnings, and we know earnings drives share price growth. For the Asia Pacific equity market area, this week. So markets are tipped to pair back for the first time in 4 weeks. So Asia Pacific equities have gained for 3 straight weeks now. If you look at the ASX 200 today, for an example, our market is down 0.5% after rising for 3 weeks. And that being said, if you do have a look at the best performers again over the last 3 weeks, they're in mining and energy. And as Redmond said, we're seeing a lot of momentum from the reopening trade in China. So the best performers in the ASX over the last 3 weeks have been in some of those global names like BHP. They're up 15% over the past 3 weeks. And you've also got BHP's spin-off South32 up 15% as well. In terms of what APAC clients are doing across all of our regions, most clients, believe it or not, are in a buying state. So they're buying into this short-term rally that we've been speaking about for some time. So in June so far, 71% of the orders have been buys from an equity standpoint. Tesla has been the most bought and sold share. Notice that I didn't say bought and sold. Apple is the second most transacted share. Now, on Tesla, 53% of transactions were shorting. So clients are betting that there could potentially be some more downside. Why is that? We spoke about last week, Tesla expecting their margins to be flat, and that's according to consensus as well. And Tesla, as we also said last week, they're considering cutting 10% of their workforce. Also, they're dangling the carrot of potentially buying a lithium mine. And if those two things happen, cutting the workforce and buying a lithium mine, then Tesla could be a very different story, which is why we're seeing some clients buy into Tesla. The most conviction across all stocks, CFDs and ETFs, the second most bought, aside from those two shares that I've mentioned, is the iShares MSCI USA ESG Enhanced ETF. It's a very mouthful, long name, but it's basically bundling in together the largest stocks in the US that are focused on decarbonisation. So 100% of clients transacting on those were buys. In bonds, all transactions were buys, and this reflects that clients are taking a view that yields will rise, and this is something that we think as well. And so we think clients are using bonds given they'll likely outperform cash, given inflation is going to be higher for longer. We do also think that bonds play a good part in a portfolio with downside protection. What else to consider? I'll start at a broader equity view. So the best performing sectors or baskets, as we call them at Saxo, so far this year are in commodities and defence. They're the only two baskets that we track globally at Saxo that are in positive territory. And we think that in terms of money flow in 2022, these two sectors will likely see more money flow. So I think it could be a consideration to look at those. The Reserve Bank of Australia is set to meet tomorrow in Australia, and they're tipped to take rates up from 0.35% up to 0.6%. Remember that we had in Australia 2 better than expected economic reads this or last week. And plus, you've also got Shanghai emerging from lockdown. And this comes at a time when Australian exports surged to an absolute record all-time high. So the Aussie economy is growing stronger than expected. Plus, we've got Australia's new Labor government supporting full unemployment with their new childcare policy. So this basically means all this added in together, and the RBA has got more ammunition to rise rates more than expected. So this will likely take the wind out of tech stocks sales. As to potential trading and investing ideas, I guess with central banks being more hawkish, caution is in the air as we started this a session with True. So caution is in the air for 2022. Delinquency rates are now expected to rise in the second half, according to Bloomberg. So if you use inflation, I guess, as your friend, so to speak, it could be worth considering investing in those sectors that are key components of inflation. So oil and agriculture and mining. And the last thing to mention from me is that it's S&P or sorry, it's the Dow Jones indices. The S&P Dow Jones indices is the group that essentially makes indices, and they've rebalanced those for the 20th of June. And we'll put up a note today included in our APAC digest and spotlight. So keep an eye on those stocks that will be added or removed from those key indices that you like to invest in. I think we'll leave it there. But thank you very much from the three of us, from everyone here at Saxo. And please don't forget to reach out to your RMs or your GSTs for any questions, feedback, or comments. And also don't forget to take advantage of a one-on-one with us, and we can talk to you about potential investment opportunities that we're seeing in the market and other avenues for potential investments, and also ways to look at hedging your portfolio with further potential downside ahead. So let's leave it there. Have an amazing day.
Thank you, guys. Have a good day,
Thank
good week
you.
ahead.